Get your free copy of the complete tutorial at www.teachucomp.com/free. In order for managers to plan, direct, and control effectively, they need good financial information to make informed decisions. One of the most important concepts is understanding cost. Managers should be asking questions related to cost, such as what costs are involved in making a new product, providing a service, or implementing a new plan? If we decrease production volume, will costs decrease? And how can we control costs overall? Next, we will take a look at the different types of costs that managers can control in a corporation. Manufacturing costs consist of direct materials, direct labor, and manufacturing overhead. Direct materials are raw materials that can be physically and directly associated with the finished product during the manufacturing process. Indirect materials do not physically become part of the finished product, or they cannot be traced because of their physical association with the finished product is too small in terms of cost. Direct labor is the work of factory employees that can be physically and directly associated with converting the raw materials into the finished goods. Indirect labor refers to work that has no physical association with the finished product. Manufacturing overhead consists of costs that are indirectly associated with the manufacturing of the finished product. These are all costs that are not included in direct labor and direct materials. So indirect materials, indirect labor, depreciation on factory buildings, and insurance on factory buildings are all included in manufacturing overhead. When it comes to cost, it's also important to understand the difference between manufacturing costs and non-manufacturing costs so that financial statements can be filled out correctly. Each of the manufacturing components are product costs. Product costs are necessary when producing the finished product. Companies will record these product costs as inventory. Period costs are costs that are matched with the revenue of a specific time period rather than included as part of the cost of a product. Companies use period costs by deducting them from revenues in order to determine net income. This chart shows the differences between product costs, which are also known as manufacturing costs, and period costs, which are also known as non-manufacturing costs. Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.